I'm Carlos Gonzales from Royal Gold Academy, and I want to talk today about the upcoming Bitcoin halving. What should you know? I'm taking this information from site primexbt.com, and I found that it was the best explanation for what's coming up with Bitcoin and the halving. You see, one of the major reasons to why Bitcoin is heralded as such an impeccable example of a digital currency system has to do with its supply regulation and its inflationary mechanics. The way in which Bitcoin is created as a financial system sees it have a set and mathematical unalterable supply of 21 million coins. However, having a precedented or predetermined supply is one thing, and one reason why it is superior to gold with its unknown supply, but the other important factor that impacts its scarcity and inflation is what is known today by most persons as the halving. This hard-coded event has great implications on Bitcoin's supply and creation, and is happening for a third time this month. The halving, which sees the reward of unlocking a new Bitcoin block cut by 50%, happens every 210,000 blocks, or roughly every 4 years. The next Bitcoin halving will occur at block number 630,000, which is expected to take place on May 12th, 2020. The halving will reduce the block reward, which is the amount of Bitcoin that is paid for figuring out the algorithm for a new block, where it was once 12.5 Bitcoins per block. It's now been, yes, that's right, half to 6.25 Bitcoins per block. This will also take the supply inflation from 3.72% to 1.79%. This will take Bitcoin's inflation rate under 2% for the first time ever. And this is an important margin, as the 2% inflation target used by most central banks for the fiat currencies. As of January 31st, 2020, 18.19 million coins have been mined, which is approximately 87% of the total supply. While this is a rather technical occurrence and primarily influences the mining and network health of the coin, it usually has greater implications for the market and the price of the coin, as it is generally seen as a bullish move for the coin. As mentioned, Bitcoin will be seeing its third halving in history. The first halving took place on November 28, 2012. The second halving took place on July 8, 2016. As these events continue to happen, so the inflation level will keep shrinking until the final block is mined before the 33rd halving on block 6.9 million. And here the mining reward will drop to, yes, that's right, it will drop to 0, with a technical supply cap of 20 million or 20 million Bitcoins. The last coin is expected to be mined in March 2140. You hear that? March 2140. The first halving in 2012 took the reward from 50 coins down to 25 coins, with an assumption that 144 blocks were mined per day. This event caused daily supply, adding to the circulating supply, to decline from 7,200 to 3,600 coins. The second halving took place and took 25 coins and cut it by 50% to 12, that's right, 12.5. And it's what we are currently, or miners are currently being rewarded. This meant that new coins fell from 3,600 to the current rate of 1,800 coins per day added to the supply. In both halvings previously, there were bull runs prior to the event, but unlike the first halving, where the upward trend, where bulls run prior to the event, 1 year before the halving to the event, Bitcoin experienced a second bull run, but it was 9 months prior. Bitcoin's peak to its all-time high of $20,000 saw a 9.054% appreciation in price. Between the relative price bottom of $213 on September 21st, 2015 and the relative price peak on December 16, 2017, 18 months after the second halving. This is similar to what happened in the first instance of the first halving, and this bull run also saw a fall of 80% or minus 80%, bottoming out in December 2018. The similarity of price movements between the two events allow for conclusions to be drawn for the upcoming event, which could follow a similar pattern. Both halvings before indicate a 2-year upward move in Bitcoin's price by the halvings, which then followed a 12 to 18 months of fall of upwards of 80%. The peak in the first halving came in December 2013, where it topped $1,150. This was about a year after the halving. Then 2 years later, Bitcoin's price had fallen over 80% to $212 in August of 2015. But then, the second halving's bull market cycle began. The bull run for the second halving ended nearly 2.5 years later in December 27, as price reached its all-time high. Then in the same way, the price fell over 80% to around 3,000. But a year after that, the Bitcoin's price is up again, presently over $9,000. So you're saying, well, why does all this matter? Why bring up the past? Bitcoin as a financial system and monetary asset is quite unique in that it follows a deflationary curve, which is relatively set and has no errors in it. As mentioned, the latest fall in its inflation takes it under 2%, and thus it is under what most central banks consider to be a fine inflation level. This deflationary curve also helps define the asset as it follows something like gold, which is of course a well-known store of value. Fiat currencies are well known to be inflationary assets, and thus help define a store of value against a monetary asset. But it also means the true value of the likes of fiat currencies also lessens over time. If you look at how fiat currencies have fared as inflationary assets, it is concerning just how much value major currencies have lost, especially when it comes to comparison with stores of value such as gold and silver. For example, the British pound is 317 years old, but it has lost more than 99.5% of its value since it came into existence. Another instance shows how since the US officially ended its tie to the gold standard in 1973, the value of gold has gone up by plus 1,760%, while the dollar has inflated to 472.53%. At the same time, this means that $1 in 1973 had the same purchasing power as $5.73 does today. Because Bitcoin is more closely aligned to gold, often referred to as digital gold, as compared to fiat currencies with their high inflation curves, it is worth looking at different measurements for gold while trying to ascertain what Bitcoin will do. What also helps is looking at the scarcity of Bitcoin, which is far more miserable than with gold, given that Bitcoin is set at 21 million coins. Part of the reason gold's value holds well over time due to its scarcity, which is measured by the stock to flow ratio, or it's called the SF ratio. The SF ratio quantifies the scarcity of an asset, measured by dividing an asset's total circulating supply or stock by the amount produced annually, the flow. The SF recognizes the economic utility of a consumable good is realized when the good is used, but the utility of investment assets with a high SF ratio lie in their storage and eventual resale. For reference, an asset with an SF ratio of 90 will take 50 years of the current production rate to double current stock levels. It shows that assets with a higher SF will give off lower annual inflation rates. And it is seen that gold exhibits the highest SF of metal commodities. But Bitcoin's SF is expected to take the lead when the fourth halving takes place in May 2024. What is interesting to note is that the SF ratio may be unpredictable for commodities like gold if major deposits are suddenly found, or if technology advances see cheaper mining or extraction processes. This is where Bitcoin benefits from mathematical certainty of a known supply and its movement into circulation based on current network parameters. There's a lot of focus on how the halving will impact the market, but overall, this event is a huge factor for the miners and the mining ecosystem, as their profitability is instantly cut by 50%. This may seem like a huge blow for the miners who rely on fine margins, but it is more complex than that. By the regular change of Bitcoin's mining difficulty, how challenging the protocol is for solving the calculations required to produce valid blocks in the blockchain adjust programmatically every 2 weeks. So there will be an expected change in difficulty after the halving to make it more inclusive. This is how miners will feel the impact. 1. Miners will experience an estimated 45% to 50% decrease in nominal Bitcoin rewards. Mining profitability will come under pressure, but it also depends on Bitcoin price performance going into the halving. Operating costs, including electricity, will remain largely fixed. If the price is around $9,300 gross, annual mining revenue will drop from $6.1 billion per year to $3.1 billion per year. There's expected to be a minor capitulation if they choose to exit the market, and this could lead to a fall in hash rate as well as a security. But that fall in security is not expected to be great enough for any major concern. Transaction fees are also a part of the mining consideration, as higher fees incentivize miners to produce a transaction. Therefore, transaction fees will be more closely correlated with an increase in demand rather than the halving itself. It is not expected that transaction fees will increase in direct response to the halving, but they have on average been increasing over time. But as it stands, Bitcoin they don't have the transaction volumes or fees to compensate for the halving in rewards. So there will be a big reduction in miner revenue. Total miner revenue will be reduced by an estimated 58,125. And if this was to be compensated by transaction fees, the fees will need to rise over 20 times. Listen, in conclusion, the halving is predicted to be a bullish event for Bitcoin, as all I have said has explained. But it also helps to point out in what direction and designation Bitcoin is currently in. It is deflationary and more like gold than fiat, and thus Bitcoin, designed to be digital cash, has leaned towards being a store of value. This means the halving will have a big role to play in its future success of such an asset. We have seen as Bitcoin started becoming a better source of value or store of value, the two previous halvings have pushed its price up in familiar and constant patterns. Moreover, the fall of the inflation to below 2% suddenly makes Bitcoin a better asset than a top fiat currency, as the central bank looks to maintain at best 2%. But Bitcoin also benefits from being with a constant supply, and that also could see it overtake gold sooner rather than later. This ties back to the stock to flow model, where Bitcoin, in comparison with other metals, is right up there and predicted to even overtake gold with its set supply following its fourth halving in another couple of years. So while Bitcoin may be struggling to compete with mass adopted payment systems due to price volatility, scaling limitations, and a complex user experience, it is heading more and more towards being a store of value. And that is all thanks to the halving. So that's it from me today, Crypto King Carlos. And I want to invite you to consider being a part of our crypto trading for beginners. We are having our 7th cycle, and you can register now. It's an online, and Monday 11th of May, the day before the halving, we'll be having our online orientation for the course. So if you want to be a part of that, be sure and be there. Go to the link http bit.ly trader registration, and you can WhatsApp me at 464-3230, and you can be part of this revolution. I'm Crypto King Carlos, signing out from you today, and you'll hear me again in the near future. God bless. Have a great day.